2012 federal budget was made public recently, proposing significant changes to the way SR&ED funding and venture capital was dealt with. So what we have here this morning is an expert panel that consists of Graham Smith of TSGI, which is an accountancy that specializes in SR&ED, and our second panelist is Randy Thompson, the CEO of Venture Alberta, to talk about angel and venture capital funding. So I'll turn it over to Graham to discuss the federal budget as it relates to SR&ED.
So the first thing is, what is the context and the themes that are part of this budget? In the last 10 years, there have been study after study after study that have showed that Canada is lagging in commercializing and innovating its technology. And what these studies have discovered is the problem is not that we do not spend enough money on R&D or that we are not accomplished enough in R&D. The problem appears to be that we are not as advanced in commercializing that technology as many of the other countries in the world. By way of example, we spend on higher education, we're fourth out of the OECD. When it comes down to actually getting economic impact out of those things, we rate somewhere between about 18th and 31st out of 31 countries, depending on who you want to believe. So the government has finally woken up to the idea that we are maybe losing traction in terms of innovation. So that is the context going into the budget. So the government took all this information and said, what are we going to do about it? The recommendations were very broad, they were very sweeping, there were many of them, but I've boiled them down into 5 points. So the first one is simplification of the SR&ED program and a reduction in funding of the SR&ED program. That was a major recommendation of the Jenkins report. Second thing was increased use of direct subsidies by government. So the Jenkins suggestion was take money out of tax credits, put it into direct subsidies. The third thing was increased use of government procurement programs to drive innovation. This is something that many other nations do. The US is probably number one in that through the DARPA program. They use government purchasing power to drive innovations that they believe are important. Germany is also key on that, and Israel as well. The fourth point, the major recommendation, was to improve access to venture capital. For those of you who have kicked around the technology space, you'll be familiar with the concept of the valley of death. Companies create a technology, they get it to the point of validation and feasibility, and that's not at the point where investors are prepared to come in. They need capital to get through a low point in their lives when actually their capital requirements are increasing, but they are not ready from an investor's point of view for someone to invest major dollars to finish the process. The fifth recommendation was to refocus a lot of the government and academic research in the country less towards curiosity-based research and more towards industrially relevant R&D. The changes to the SR&ED program that are proposed are very large. One of the things I should say is the budget makes these proposals. These are not enacted in legislation yet. They are going to take a number of months. These things are going to go to committee. There's going to be a bunch of argument and possibly modification of these things. And then it will be enacted into law sometime in the next 3 to 10 months typically. But it's not written in stone yet. If you don't like what you see, you can call up your MP or you can call up the science and technology critics for the opposition parties and have your say and make your input. So not written in stone yet. First and most important thing is a reduction in the general SR&ED ITC rate. So for those of you who may not be familiar with SR&ED, when you get a tax credit, there are 2 ways that you can do that. If you are a CCPC and you are under your expenditure limit, which for the sake of argument we'll say today is $3 million, you can get an enhanced ITC rate of 35%. So 35% tax credit back on your research and development costs. If you are not a CCPC or you are a CCPC who has spent more than $3 million, you are going to get what's called the general ITC rate. That's a 20% rate. So what the government has proposed is they're going to leave the enhanced ITC rate of 35% where it is, but they have proposed to reduce the general ITC rate from 20% to 15%. So that's a 1/4 reduction. This in fact was not one of the recommendations of the Jenkins panel. So the government has diverged from the recommendations of that study already. For organizations that have a fiscal year end other than December 31st, if you span the December 31st period, your rates are going to be prorated depending on the number of days that fall into those calendar years. For those of you who aren't familiar with some of the acronyms, I should say CCPC means Canadian Controlled Private Corporation, and there are spending limits and capital limits that also are required in order to meet the qualified status for that. ITC is the investment tax credit, so that is what you get back as a tax credit for your R&D spend. Second change, and this is going to be substantial in Calgary, we believe, is the elimination of capital expenditures from SR&ED deductibility and investment tax credits. So currently, if you have a capital expenditure, you need to buy a supercomputer or a compressor, something big and important, a capital item for your SR&ED projects. You can claim those as a SR&ED deduction, and you can get an investment tax credit on them. What the government has proposed is to eliminate that tax credit for capital expenditures starting January 1st, 2014. They've been very thorough about this. They've said, okay, we want to make sure we eliminate these capital expenditures, and they obviously thought about it. They said, okay, people are going to start leasing these items instead of purchasing them. So what they have done to prevent that is they have said, okay, this applies to leasing arrangements also of capital property that otherwise would have been purchased. So they are actually knocking out the capital items directly and the leasing costs associated if an organization chooses to lease an item that would otherwise be capital and purchased. This is going to apply as of January 1st to capital items purchased then, or lease payments payable or paid after January 1st, 2014. So we've got a little bit of time, a couple of some windows, 2-year windows nearly, before this change comes into effect. The next thing that they are proposing is to reduce the SR&ED contract rate from 100%, which is where it is currently, to 80%. So currently, if you are an organization that contracts out to have SR&ED done for you, you can claim 100% of that cost. What is proposed now is what they would like to do is they want to disallow the profit element of a contract between two arm's length companies for SR&ED tax credits. So they have said, okay, rather than try and calculate the profit element for each contract individually, they're just going to say, hey, we're going to take a 20% surrogate. So where you used to be able to claim 100%, now you can claim 80%. They, again, were very thorough about their thinking about the capital side of this. They realized that what companies might do is hire a contractor to buy a capital item in order to execute a SR&ED project. So what they have done is they've said, okay, every contractor will be required to indicate to their payer company what capital items they acquired in order to do this SR&ED project, and those capital items are going to be subtracted from the contract cost, and then the residual will be multiplied by 80%. So conceptually what they want to do is make sure they are not paying for profit in a contract between two arm's length organizations, and they are not paying for capital items. So a little bit of complexity there, and there's going to be some reporting requirements now between contractors and payers that weren't there before. So that's going to affect people quite a lot. Fourth item is they have reduced the proxy overhead rate. So for those of you who may not be aware, it's possible to claim overhead costs for a SR&ED claim. There's two ways of doing that. That's the traditional method, which is the line-by-line itemization of costs which were directly incurred and incurred only for SR&ED purposes by someone doing research and development. That's where you add up the utilities and the square footage and that your engineer takes up, that kind of thing. That is the traditional method. But many years ago, the government realized that they were having a lot of conflict with the industry over this overhead approach. So what they did is they all shook hands and said, okay, we're going to give people the option to walk away from that unpleasant calculation and take a 65% increment on directly engaged labor. So walk away from the complicated calculation, just take your labor base, multiply it by 1.65 and put that in your SR&ED claim. They did that for a very specific reason. A great deal of their conflict with the industry was over this overhead computation. And they deliberately made it generous in order to incent people to choose the proxy overhead allocation. It was a very deliberate, calculated move that was good for everybody. The government has now said, okay, we think this is too generous and we're going to scale it back. So proposed as of January 1st, 2013, they're going to scale the increment down from 65% to 60%. Once you go to January 1st, 2014, it's going to go down to 55%. companies, again, that have a non-December 31st fiscal year end, they're going to prorate it by the number of days in the appropriate year. So a reduction in the proxy overhead rate that's going to affect most companies. They haven't published stats that I've seen, but most of the studies said that the vast majority of claims are make the proxy election. So it's going to affect, close to 80, 70, 80, 90% of taxpayers. One of the key recommendations was to simplify the SR&ED process so that it is easier for claimants to make a claim and receive the benefits. They haven't done anything directly in the government to address that, in this budget to address that. But what they did do is they have provided $6 million to the CRA to look into some changes. So what are the things they're looking at? One of the things they're looking at is improving the self-assessment tool. We met with the CRA just a couple of days ago. They said, hey, we recognize the current self-assessment tool is not a particularly good a piece of software. They told us what the numbers were. They're getting thousands of hits on it, people going through it, but it's not really effective. So they're hoping to pump that up. They said that they are much more impressed with what they're seeing now, but I think we've got to wait and have a look at that before we pass any judgment. One of the other things they're going to do a feasibility study of whether they can make the pre-claim project review process more effective. Under the current rules, you can request that your project be looked at by a CRA representative before you make a submission, before you even start the project, in fact. Pre-claim project review. The problem with that has been that it's not a binding situation, so industry as a whole has not found it very effective. So they're going to look at whether they can basically give you a pre-ruling on your tax situation for your project. Nobody's sure if that's going to be successful, so we're just going to have to see how that goes. They have promised to work more collaboratively with industry. We're going to see how that goes. We've actually, I would say, in the Prairie region, we've already started seeing those kinds of changes coming through. The new assistant director is a very open, communicative sort of person, and a breath of fresh air, I would say. The other thing that they proposed is more frequent use of tax alerts. We don't really know what they mean by that, and they haven't been forthcoming about it, but we'll see what happens. And one of the other things that has been, that will be very welcome, is the inclusion of a second science review in the notice of objection process. So right now, if you submit a notice of objection, there is no second review on the science. Whatever the first science reviewer said, that's the science assessment. If it goes, the objection group can look at that, but they are not currently set up to undertake a second science review. So they have planned this was a big request of industry, certainly something that TSGI was working with the government as a recommendation, is to include a second science review. So they have moved ahead with that. That's definitely good news for all the taxpayers. They've also committed to study what's happening with SR&ED consulting fees. We don't really know what's going to happen with that. They basically said we're going to have a study. So see where that goes.